Alrighty. So today is October 29th. It's almost Halloween. And the first month of Q4 is almost over. So this is going to be a bit of a different show. And that might be a permanent change. I don't know. So this last week, I was at FinCon 2024. And it's all about people in the finance world who create content, things like this. FinCon was great. I learned a lot. I met a lot of great people. And it really helped crystallize something for me. And that is, I need to not shy away from my actual core beliefs. And so what do I mean by that? There's a couple different layers to what it is that we do here at Tax Sherpa and why I founded it. If you've tuned into this show before, you'll have heard my story about how I went through my own entrepreneurial journeys. I ended up getting nasty letters from the IRS. And then in fixing my own problems, I fell into this whole tax world. And it's now part of my mission to help people like me, essentially small business owners, solopreneurs, independent contractor, freelancers, basically anybody who doesn't have a day job for somebody else is a good candidate for Tax Sherpa, because I can go in and along with my team, we can structure things in a more tax efficient way and save tons of money. So that is the individual levels of the mission. However, there's a bigger part to the mission. The bigger part is I want to defund the government. And people talk about defunding the police and everything. I want to defund the whole thing. And there are reasons for that. But fundamentally, I think the world would be a better place. Also, I think people do a better job with their own money rather than handing it over to the government. We're going to be rebranding this show instead of just the office hours. We'll still do questions and answers and everything, but I think we're going to rebrand as something like, the Defund the Government show or something like that. And a large part of that is technology. And we'll get into that a little bit later about how we use technology to defund the government. So with all that said, let's dive in. All right. So like I said, it's going to be a little bit of a different show than normal. Let me share my screen. Here's a little document that I am calling How to Save $100 billion. So I'm going to make sure that this is actually tripping up on screen because today with Zoom and the share is not working quite correctly. So let's see, is this working? And yes, it's okay. This is how to save $100 billion. Now that might sound extravagant, but I'm actually going to walk you through exactly how to do that. And it's pretty simple, but we need technology to do it. And I'll tell you what I mean by that here as we go through it. So the IRS has a division called SOI, and these guys over here. Do I remember what SOI stands for? I think it's Service of Information or something like that. But you can go through and they publish all different kinds of stuff, all different kinds of reports and things. And one of the publications is publication 4801, which is it's actually a really useful publication. It's the most recent one is from tax year 2021. And what it does is it goes through the different tax return pages and it shows you the different numbers of basically what the American public filed as in total. It'll have two versions. So here's Schedule C's, right? Profit or loss for business. This first one, because the white border has the number of tax returns that were filed with something on those lines. So 27,592,394 tax returns were filed with something in box one up here.
Julia Neal, how are you?
I'm just showing people how to save $100 billion. So it does this for every page in the tax return publication 4801. And on the following page with this little, I don't know, color that would be a greenish kind of border, it gives you the actual dollar amounts of all the tax returns that were filed with a Schedule C. And these numbers are in thousands. So this 1,834,086,335, that's actually, instead of being 1 billion, it's actually $1.8 trillion worth of revenue was reported on line one of Schedule C's in total of all Americans 844. And so this is Schedule C. And there's three things that I'm looking at here of how to save $100 billion. We're looking at Schedule Cs, we're looking at partnerships, and we're looking at S corporations. Those are the three business types, the primary ones. There's others, but the biggest ones that flow through into individual income tax returns. So if we look at that, there's actually a more detailed version of these pieces of data. So there were 27 million Schedule Cs filed, but actually when you look in the details, 21 million of them had profit at the end of it. And the total amount of profit was $516 billion. And if you divide that out, that's $24,490 per profitable Schedule C. Okay. So of the 21 million, you average it out, the average one made 25 grand. Okay. So that's element number one. Element number two is partnerships and S corporations. We had roughly 11 million total that were filed, but ones with profit, because again, we want to pay tax on losses typically. We had about 3.6 million. I don't know if you can actually see this. Otherwise, that's nice. Well, let me just do it the old fashioned way. There we go. So 3.6 million S corps, 2.4 million partnerships that had profit. They're non-passive income profit. And there's some more that had some passive income, but it's not as much. In the 100 billion, I'm just focusing on non-passive income. And then of the amounts, 451 billion there, 7 billion there. Okay. So 2.4 million partnerships with active profit, 451 of profit. That's $187,000 per profitable partnership for active entities. And for S corporations, similar calculations, comes out a little higher, $210,000 per profitable act S corporation. Okay, so how do we defund? We got to make some assumptions because we're modeling tax returns and then aggregating. So assumption number one is we're going to assume everybody's filing joint, which is the lowest income tax way to file for any given number of income. We're going to assume there's no overlap because if somebody had a partnership and an S corporation and a Schedule C, then their total income is going to be higher. That's going to raise them up in the brackets. That's going to make their total tax liability higher than if we assume they're all separate. And we're going to assume there's no other income, same reasoning. And these assumptions will create the minimum tax burden projections. Basically, this is the most conservative way to project these numbers. And in reality, it'll actually be way more than the 100 billion that we're talking about. Happens. In a Schedule C, there's two different types of tax that you pay. You're going to pay income tax and you're going to pay self-employment tax. And self-employment tax is the replacement for payroll tax, Social Security, and Medicare. At $24,490, if you're married filing a joint, you're going to pay zero in income tax if that was your only income, because your standard deductions actually would be greater than that. However, you are going to pay self-employment tax of about $3,400. If there's 21 million of those profitable Schedule Cs times 3,460, that's $73 billion worth of tax. And that comes out to a 14.1% rate. Again, this is the most conservative way we can project these numbers. We do the kind of math on partnerships because active partnerships also carry self-employment tax. They actually have a 26.3% tax rate and $49,000 of tax per one of these 187,000. Now, obviously, these are averages, right? So they're going to be skewed. Some will be zero, some will be $100, some will be 10 million. The average is 187,000. S corporation has much more advantageous tax treatment because you don't have to pay the self-employment tax. So instead of income plus self-employment tax, you're only paying income tax. And if you're wondering, yes, these numbers do factor in the qualified business income deduction. We're not being unfair here. We're being as conservative as we could possibly be. The partnerships the owners of the partnerships end up paying 118 billion, and the S corporation owners end up paying 111 billion. So the total tax is $303 billion when we added those three numbers. Okay, so that's how much, at minimum, the owners of these different business structures are paying in taxes on their 1040 tax returns. That is the least possible amount that could be possibly paid. The question becomes, how do we reduce that number? And I just picked a number, says, okay, if every Schedule C partnership and S corporation reduced their taxable income by $20,000, what would, and Serena, you tell me, can we reduce a corporation's profit by 20 grand in some tax strategy?
Of course.
Of course, all day, every day.
All day, every day.
20 grand is typically pretty easy from what we see. So what happens if we do that? The Schedule Cs go from paying $73 billion worth of tax down to $13 billion. Partnerships go from 118 to 102, and S corporations go from 111 to 95. And that's a measly 20 grand worth of extra deductions by incorporating some tax strategy. So the new tax, if we did all that to all those different Schedule Cs, partnerships, and S corporations, it's $211 billion. And that creates a tax savings of $92 billion a year. And I rounded up to 100. So 92 is close enough to 100 for me, as far as saving $100 billion from, and the money exists either way. So the real question is, which is better? Giving $92 billion to the government, and then they spend it on whatever it is they spend it on, or the owners of all these different things taking that same $92 billion and spending it and investing it and doing whatever they want to do. Same $92 billion. Which do you think is better? And for me, all day, every single time, with the owners of the money, their own choices, and spend that money in whatever way they see fit. And that's just one example of simple change can make dramatic impact if we're able to get these tools in the hands of people all across the country. So one of the things about Tax Sherpa is that we do client services. That's great. We have our navigators group where we get together every week and talk business and tax stuff. It's a lot of fun. However, there is a real limit. You can't do one-on-one services for everybody, which I wish we could, but it's just not possible. But what we can do is we can make technology available to everybody, because we can reproduce that at pretty much, we can start to show people how to use some of these tax strategies in their own business and start to achieve their own tax savings. And this is coming up with $20,000. It's like the most basic thing that we do in tax strategy. There's lots more. Taking Schedule C's, converting them to S corporations. So it's compensation optimization, retirement plans, all different kinds of things that we can do when it comes to tax strategy. There's hundreds, maybe thousands of strategies out there. And this is just federal, right? We're not even talking about state. If you live in a state with income tax, then obviously that is going to be an additional amount on top of that $92 billion. And most states do have an income tax. Okay. Now, what do I want to talk about technology? I've been getting into AI coding a bit lately. So let me show you some things that are still in testing. So here's a very simple calculator that I've been working on. The IRS just announced the new tax brackets last week, and you can put in your income. So let's take one of these numbers, right? Let's take 210,120. And if you're married jointly, you can press this button. It's going to tell you how much you can pay in federal income tax 2024 and then federal income tax 2025 with the new brackets. However, you could also put in a number for 2025. Okay, I made 210 last year. And remember, all these numbers are for 2020. I made 210 last year. Let's say I'm going to make a little bit more this year. Let's say 225. And I can click calculate, and we're going to see the changes, right? In 2024, if I made 210, that was my AGI. My standard deduction is 29.2 because of maritime insurance. Taxable is 180. Tax liability is 29.9. If we make the same amount in 2025, the standard deduction goes up, the brackets change, and instead of 29.9, I actually pay 29.4. So that actually goes down by 1.5%. The numbers of revenue is never going to be the same. If we're experiencing this inflation, typically your revenue is going to be affected as well, and your net profit is going to be affected. So it should go up over time. So if we made 225 next year, $30,000 standard deduction, 195 taxable income. Now my tax liability is 32,000, which is an increase of 9.4%. This is one little tool that starts to give you an idea of what it is that you're actually looking at from a tax perspective. And this was all coded by AI. So I talked to the AI and I gave it the data as far as like the brackets and everything, and it was able to produce this, which is amazing. Here's a second tool that I was working on last week in between going to conferences and stuff. Standard versus itemized. And this is for 2025. So let's say I got my $245,000, right? Let's hope this actually works, because that'd be embarrassing if it doesn't. How much should I spend in medical expenses? Standard versus itemized is going to be your itemized deductions are expenses that you can deduct against your other income. However, you get a standard deduction. But you always want to do this comparison. And so are my itemized, if I list out each of my individual expenses that qualify, are they greater than the standard? If yes, I'll take the itemized. If they're less than the standard, you just take the standard. So this tool will help you figure out what you're looking at there. So let's say I spend 15 grand in medical expenses, had some decent sized medical expenses. State and local taxes, that's going to be your state income tax. It's going to be your property taxes. It's going to be your vehicle registration fees, stuff like that. There are limits to that as far as how much you can deduct. But let's say you live in New Jersey and your real estate taxes are 20 grand because they have the highest property taxes in the country. Mortgage interest, this is interest on a mortgage, at least interest on mortgages where the balance is not set $750,000. And so let's say, spend 15 grand in mortgage interest. Charitable contributions, let's do 5,000. So I'm pretty charitable. Disaster losses in this year, we're going to see a lot of disaster losses for anybody like in North Carolina that was hit by the hurricanes. And one of the changes in the itemized deductions from the Tax Cut and Jobs Act was that casualty losses like flooding and things like that had to be in a federally declared disaster area. So before 2017, you're able to deduct them even if it was just, pipe broke in my house, it flooded my basement, I had to spend 20 grand on repairs. That was a casualty loss. Now that only counts if you're also in a federally declared disaster area, which I am this year. So that's a fun one. Spending 30 grand on basement repair. Where's that? It's crazy. Don't want to live with mold. So there's that. Gambling income is not a deduction, but if you had gambling losses, they are only deductible up to the amount of gambling income that you have. So let's say I won nothing, but I lost 5 grand. You'll see when it prints it out, that does not count for anything. Let's go ahead and calculate. Okay. So my standard, because I'm married filing joint, is 30,000. Medical expenses after the 7.5% floor, 0. So, but wait a minute. I had $15,000 worth of medical expenses. Doesn't matter, because the way they count it is medical only begins to count if it's above 7.5% of your adjusted gross income. So in this case, the 15,000 wasn't enough to even start counting. My state and local taxes after the SALT cap, SALT stands for state and local taxes, is 10 grand. So I had $20,000 worth of expenses, but I only get 10 because that's just Ben's rules. Mortgage interest, I get the whole amount. Charitable contributions, 5,000. And so in this case, my standard and my itemized both came out to 30,000. And so you would just take the standard deduction. Now you'll notice the gambling losses is 0 because I had no gambling income. So if I change this to 5,000, now all of a sudden those gambling losses count because I had gambling income to count against it. And you have to keep in mind that this gambling income has to be part of this gross income up here. But let's say I'm very charitable. So there's a tax strategy where we can create massive charitable deductions. Under the current rules, you're allowed to create charitable contributions up to 60% of your adjusted gross income. So now if we had an income of $225,000, that could be $135,000 worth of charitable contributions. And then our total itemized would go up to 160 grand. So obviously you would take that over 30. These are just 2 very simple tools that I was able to create last week. And again, they're still in testing. I haven't 100% tried every different scenario, but I'm pretty sure that they work. And this is the kind of thing where we could distribute this to everybody and people can start to play with their own numbers and start to get an understanding of how things work, basically. So let's say, let's just take this calculator, right? So we had the 210 and we were at 29.9. What if we were at, 190 and we took that $20,000 deduction we were talking about before? I calculate that. We might go from 29.9 down to 25.5. So that's $4,500 worth of tax savings just by creating a deduction there. You start to play with the numbers, you start to get an understanding. And I'm going to be rolling out more tools over time about, okay, how do you actually do that? I'll tell you guys the ways to do this. So one way is to implement an accountable plan. This is under section 162-2 of the code. And basically it's a reimbursement plan where your company reimburses you as an owner/employee for business use of your stuff that you're paying for out of pocket. There's a lot of things that can be brought into an accountable plan. But basically, if you ever had a job where you had to give them a receipt, they give you money, send you an accountable plan. And you just have to document how you used various things for business purposes. Another one is a summit strategy session, where this doesn't apply to every business formation because you can't do it with Schedule Cs, but your business rents your primary dwelling from you for a business meeting. And we have a whole process where you create, there's a template basically of how to run your meeting. And then you look at your books and you actually look at your books. 2 is you start looking at your business like a business owner does. So these are some of the professional management skills that a lot of small business people are lacking because they just haven't went to business school, essentially. There's actually a process to looking at your records and figuring out how business is going. The vast majority, when I say vast, 95+% of small business people, they wake up, they open up their app, and they say, oh, there's money in the account. Great. And they go out and do their thing. Or they open up their app and say, crap, there's no money in the account. And then they go out and they go hustle some more. So that's pretty much it when it comes to business analysis. What the summit strategy session does is it guides you through a monthly meeting. And so 1, you have to have your books done, which you should be doing anyway, but a lot of people don't. And then 2 is how do you actually operate your books like a manager? How do you look at the trends in what's happening? How do you try to identify what's working and what is not working? Because at the end of the day, the whole purpose of the thing is just to do more of what is working, do less of what is not working, and then maybe experiment in the margins and try to find new things that could work, right? And the summit strategy sessions guides you through that and takes advantage of tax code under section 280 AG subparagraph 2 and will give you a tax deduction at the same time because Congress will reward you for running a better business by having your meetings done correct. As we start to develop these tools that we can distribute widely, because it's just running on our website, basically, then people can start to use these tools to their own advantage and start to implement some of these taxing strategies and going from 210 down to 190 very easily. So that's where we're starting to use technology to defund the government. Really, I want to get to $1 trillion rather than 100 billion. So I want to 10x this whole thing, but that's going to take more than just saving 20 grand a pop. That's going to take some multi-layer strategies, but can totally be done 100%. I just think I'm tempted to document like a 5-layer strategy because just prepping this app took me, about a hour. You don't have all that time to be spending doing that stuff. So yeah, went to FinCon last week. It was a great conference. If anybody in the audience is into finance and creates content, it's a great conference. Next year, they're doing it in Portland. I had never heard of it prior to getting ads past month or so, but it was here in Atlanta. So I was like, local, I'll go. I'm very glad that I went, and I recommend it for anybody who is a fit for that. But it has convinced me that we need to start doubling down on defunding government, because that is the bigger mission. And as far as I'm concerned, that will make the world a better place. I know some people disagree with me, and that's okay. You don't have to agree. We can't save everybody from the mind virus. But for those of you who agree with that mission, then we're here for you. All right. So that took up half our time. I did want to get to some Q&A. Serena, what do we have lined up for far as questions this week?
So we have an investment question. So someone wants to know, what's the best way to minimize taxes on investment gains?
On investment gains. So depends on the right? So it depends on what the investment gain is, like how much it is, what type it is, what kind of asset it is. So let me walk through that for a second. Simplest type of gains is just like selling a stock. There are long-term gains and short-term gains. Long-term is I held the thing for more than a year. Short-term gains is I held it a year or less. So you definitely want to do long-term gains if you can. Basically, your tax rate will essentially be half of it would be if it were short-term gains. And it could be zero if your total income for the year is like less than 50 grand or so. So that's thing number one. You want long-term, not short-term, because short-term just counts like any other income. Thing number two is in the case of a stock scenario, you want to look at tax loss harvesting. In fact, one of the people I met was a guy named Daniel at FinCon, and he is part of a company called FREC, FREC. And they have a kind of amazing, is it FREC.com? Yes. So these guys have a really amazing platform that I'm looking at, and I've got a call with them later on, I think next week, where what they do is they will do direct investing and tax loss harvest along the way. And what I mean by that is that let's say you want to buy the S&P 500. Now, there are many ways to do that. You could go out and you could buy an index, and you could go out and buy an ETF. You could go out and buy a mutual fund. All of these have the S&P 500 inside of them. Or you could buy 500 stocks. That gets difficult, but it's actually the best way to. The reason it's the best way to do it is because there's no management fees if you are doing your own investing. And then if you get the dividends, you can decide how to treat that. What these guys do is they do direct investing to get you that index. So that I think they have 20 different indexes or indices that they can mirror. And then along the way, what happens is each day or like multiple times a day, it'll actually check each stock against your cost basis. And if it's down by a certain percentage or more, it will actually sell that stock at a loss. And then it will replace it with a stock that is not in that index, but is in the same sector. So let's say like McDonald's got hit last week because the Sweet E. coli broke outright and it was down 10%. So let's say you took advantage of that. You sold the McDonald's stock for a loss and you replaced it with Burger King. So that would be an example of a swap. Now, what that does is that gets around the wash sale rule, where if you sell something and then buy it back within 30 days, it basically is like the sale never happened. They just discount it entirely. So you have to be out of that stock for at least 30 days before you buy it back in order to solidify that loss. However, if McDonald's is down 10%, you don't want to miss out on the rebound. So you want to have something that's in the same ballpark, but not the same, so that you can get some of that same price exposure. And so I was talking to these guys, and they were saying, essentially, when they go through this strategy, your net position on the index is within 0.1% of the index if you held it perfectly. But at the same time, you're building up all these tax losses along the way, so that when you do sell and when you do have those gains, you have those other losses carrying along that will offset that gain. So that would be an example of a strategy. That's a longer term strategy because it takes time for those losses to build. When you think ahead, you can start to do things like this and save yourself a giant amount of money in taxes if you're a heavy stock investor. So that's if it's stock though. What if it's real estate? If it's real estate, then you could look at installment sales to spread out the impact of the tax over time. You could look at 1031 exchanges, which is completely tax-free if you roll over all of the proceeds. And then as long as you keep that money at work investing in real estate, then it's tax-free. And you can do that again and again, as long as you keep the money working in an investment. That's one of these incentives that is created in order to have real estate investors provide housing for people, essentially, or provide commercial space or what have you, but primarily housing. And it's not a tax-free strategy. It works perfectly. If you're selling a business, are you selling business assets? Are you selling business stock? It depends. If you're there's all different kinds of things you can do when you're selling your business. So if you have employees, then we have an employee stock ownership plan. You can sell to that plan so that your employees start to own the business directly. And that can be a tax-free sale for you as the owner, as the full. You can do a 1202 sale where if you have founder stock, the C corporation, and you sell the stock, you can get up to $10 million of gains tax-free. If you're doing an asset sale, which is more common in a small business space than stock sales, then you can start to do installment sales and all these kinds of things. So there's lots of tax strategies that are involved in the in investments, but it depends very much on what type of investment it is, what kind of sale it is, how long you've held the thing, and all these different things. There's also the pure version of you sell something, let's say it's stocks, you have the big gain, and then you take that and you invest it in active real estate, short-term rentals, or something that you spend a lot of time on. And you cost segregate that property and you get a massive tax deduction in the front year. So that's not reducing the capital gains tax, but what it is, it's adjusting your entire tax position from a year, and it's going to lower the overall thing. Because it doesn't really matter if this thing is tax-free or that thing is tax-free. What you care about is the total amount of tax at the end of the day. So I can go on and on and lower, but fundamentally it depends. But the basic factors that it depends on is how long you've held it, what kind of thing it is, and what kind of sale you're doing. So those three things. Does that, you feel like that actually answers the question?
Yeah, that's really wrong. We have that business related tax question.
I could barely hear you.
Oh, I'm sorry. So we have a business related tax question. Someone wants to know, how should they handle their estimated quarterly taxes? And is this necessary to file taxes if they're a business owner?
Okay, so I'll do the last part first. Is it necessary? Is it necessary? No. So what happens if you don't is that you get an additional tax at the end. Depends on the interest rates. Right now it's about 8%. So let's say you owe $10,000. You didn't make any estimated payments. So you send it all up for April and the IRS is naughty. You're supposed to do that. You got to file Form 2210, which is part of the tax return. And we're going to charge you $800 on that 10,000 roughly. And so that's what happens if you don't do it. And you pay a little bit more. So we're going to explain that to business owners. Business owners, the majority of the time, they have things to do. So they don't want to have money sitting in an account at the IRS. Some do. Some like that security, but most business owners are a lot more aggressive than that. And they'll say, I'd rather use the money myself and I'll pay the extra at the end. Okay. Just be aware that's what's happening. And sometimes they get themselves into trouble and you shouldn't have blown all your money and got yourself into tax trouble. There was no names or anything, but one client came to us recently, has a huge day job income, several mid-six figures, basically, and no tax withholding because I don't know why. And so we couldn't afford to pay taxes. I was like, yeah, I don't think that's true. But the IRS certainly won't think it's true because we talked about doing an offer in compromise. And what an offer in compromise is an offer that you're making to the IRS. And you say, hey, I have this tax bill. I can't pay it. Will you compromise? And there's a formula for that. It's not just a win, right? There's a formula where they list out your income, typical household expenses based on family size, how much equity you have in your house, how much equity you have in bank accounts, and all these different things. And it comes to a number at the bottom. And if that number is greater than the tax, then they will not accept an offer to compromise. If that number is less than, and it's spread over a certain payment schedule, then yeah, they might take it. And it takes 6 months and it's all the thing. But very rarely will people actually be able to successfully get an offer in compromise accepted. It's just one of those things. So if you are in a position where you know you're going to have a tax liability and you decide to wait on it and pay the extra later on and pay that underpayment penalty, which is what it's called, then just be very careful. That's my advice. Be very careful. Don't blow the money that would have gone towards the taxes because that's not what you don't want. You don't want to get the nasty letters that I got. It's not fun. So that's if you don't pay it. If you do pay it, then that's fine too. If you're self-employed or the equivalent, like you own your own S corporation or partnership or something, and your income is variable, what you want to do is want to project to actual. So there's two different methods. One is you look at last year's amount and you say, okay, as long as I pay at least that plus a little bit more, then I'm good. So if last year my taxes were 10 grand, well, net, what all said and done, as long as I pay 11 grand this year, spread out over 4 periods, then we're set as far as penalties go. Now that may or may not be the right number though, because you're just projecting, last year, this year is different. So maybe you still end up with a balance due at the end. Maybe you get a refund. It just depends. Depends on how the years went. So what I prefer is to actually do a projection quarter by quarter and making estimated payments based on that. I'll show you. So one of our tools is the Trailblazer Toolkit. And if you're in the Navigator streak, you get this for free. So let's say we're in October right now, right? October's actually ending. So let's say each month we had $5,000 was picking. Right? So that's 50 grand altogether, right? And we have to fill this out, right? Every filing joint is fine. And the way this worksheet works is we're assuming it's an S corporation. And so we go to our personal projections and it says in October, September would have been the last one. In the last quarter. And what we said that our projected tax load based on this is $6,200. And now you have to ask yourself, is like, am I caught up to $6,200? Let's say I paid $500 here. Say I paid $600 in February. Do that. Say I paid $100 in March, $200 in April, $700 there, $300 there, and so on. So I wrote this formula. Okay, so I was $2,400. So this is $2,400, and I'm trying to get to $6,285, and that is not going to get me there. So I'm going to start picking up the pace. I can start. Let's just do 700. 700. Now I'm at 4,500. Okay, we're getting close to our $6,200 total. If you do these actual projections, you can start to put in on exactly what your tax liability would be, so that by January 15th, when you make the last estimated payment, that you actually are right on target with what you are done, because you've done these pro forma projections throughout the year. So that would be the better way to do it. So those are your three basic options. Don't pay them, take the penalty, pay them based on last year's numbers, or do the actual projections quarter by quarter and project as well as you can. The difficulty with doing the projections is you got to do a pro forma tax return. And that's what we're doing here under a certain set of assumptions that is pretty common to our client. It's complicated. It's done a vastly more accurate way to do it. That is how you do quarterlies. One of those three things.
Yep. Or you can come see us and we can help you.
Or that, yeah. We do that work.
Yeah. So we have an education question about the 529 plans. Someone wants to know, how does 529 plan work? How do they work? And what are the tax benefits involved?
So the tax benefits on a federal basis, the tax benefits are that when you use that money for college stuff, the investment gains are tax-free. Okay. It's like a Roth IRA where you put money in, you don't get any deduction when you're putting money in. Then it's invested in something, and there's different plans that do different things. And then when you use that money, hopefully there's some sort of appreciating amount, and you do not pay taxes on that appreciation. So that's the basic idea of how it works. Now, some states will give you a deduction at the state level for a contribution to a 529, but that's going to vary state by state. Now, how they actually work is there's two basic kinds. One is where you are doing an investment style where you're putting money into a special account, you're taking the money in that special account, and you're buying stocks, bonds, whatever. It's usually a fairly limited list, but you can buy different investment opportunities. The other type of 529 plan is a prepaid plan, like Florida Prepaid is one of these, where basically they're saying, okay, if you are a Florida resident, you have a kid in Florida, and you want to prepay for a Florida college, we're going to give you a price that's now based on however long it's going to be between now and the expected time of college. And you can basically lock in your price now, and they're guaranteeing that they will cover whatever package that you choose. So like in Florida Prepaid, you can get like a 2-year plan or a 4-year plan, or you can add meals and housing, or you could just do the books and tuition, stuff like that. So there's different options. They're saying you are pre-purchasing this particular package. And if you go to a non-Florida school, we will pay the equivalent to this other school on your behalf. So you're about losing out in that kind of scenario. So that's how they work. And then if you don't use them for education, and the beneficiary, just the child, ages out of the program, then basically converts to an IRA. So there's the basic idea. When it comes to the money you're putting in, by and large, not a tax deduction, but when you take the money out, also not income. So that's the primary benefit.
Okay. Awesome. So we have a audit question. Client wants to know, what common mistakes do people make that could trigger an audit? A lot. You're going to say a whole bunch of them.
There's different risks. There's different factors that can cause audits, and none of them are guaranteed. It just creates risk elements. So the biggest one is just income. And the higher your income is, the higher your chance of audit is. So you have a roughly 0.5% chance of getting your name picked out of a hat, just random. But as you make more money, that number goes up. And if you get over $1 million, it's, last time I saw statistics on it, it's about 5% chance. That doesn't mean that you will get audited, but it just increases your risk. So then there are things that will, so that's just across the, then there are specific issues that will increase your chance of audit. So one is if you do things that on the face of them have problems. One is unreimbursed partnership expenses. This used to be used all the time. And in fact, when I reviewed Donald Trump's tax returns, they got leaked. He had used unreimbursed partnership expenses. So basically, it's exactly what it sounds like. It's saying, hey, I'm in this partnership. I paid for this thing out of pocket and I didn't get reimbursed. So I'm taking it as a deduction on my itemized expenses, on my itemized deductions. And that is allowable if it is spelled out. That is how it's being treated in the operating agreement of the partnership, which nobody ever does. The vast majority of UPEs, as they're called, are not legitimate because they don't follow the rules. So the better way to do that is just get reimbursed from the partnership. And then it becomes a deduction at the partnership level instead of at the personal level. And you don't have to deal with these things. And that's accountable, like we talked about earlier. So if you're in a UPE, or if you have UPEs on your tax return, and it'll be abbreviated that way, so UPE on the Schedule E, page 2. If you have one of those, that's an audit risk. If you are in a conservation easement, whether directly or indirectly through a conservation easement fund, it's an audit risk. And not because you did anything wrong, but just because other people did, and they made it bad for you. And so they got themselves on what they call the dirty dozen list. Most people have never heard of it, but the people who do have heard of the dirty dozen list, they get very skittish about it. It's not that these strategies are illegitimate. It's just that other people have abused them. So you got to be careful. That's all. You just follow the rules. It's very simple. Another audit risk is mileage on Schedule Cs. And I have seen people come in with crazy numbers on their Schedule Cs. I drove 100,000 miles last year for work for my little small business. Really? Did you? One, do you have records of that? No. Two, that's whatever 1,000 miles a day, or whatever the numbers look out to be. And yeah, there's 3 people that actually do that, but for everybody else, no, that's not what happened. That's a big audit flag. Things that don't match is pretty much a guaranteed audit. So there are these information reports. So 1099s, 1098s, W-2s, these are all information reports that are provided to the IRS by third parties. And if your tax return does not match what the other people, the third parties reported in their information, then you're going to get a letter, almost certainly. And what level of letter varies depending on the thing. But at the very least, you're going to get, hey, you didn't include this, pay us, at the very least. Other things that are audit risks are, there's out and out scams that are out there, like the federal fuel tax credit scam. If you buy gasoline or diesel, and inside of every gallon that you pay, let's say right now the pump's about $3, at least where I am. If you're in California, I'm sorry, whatever, $6, almost twice that. So where I am, it's $3 a gallon. Inside of that, there's a percentage of that is federal tax. And there's also state tax in there, but the federal tax, if you then use that gasoline and use it in like off-road construction or charitable purposes or things like that, then you can get a rebate on that tax that you paid because you didn't use it for use on the roads that are supported by the National Highway system. So the feds have a credit where you can get that money back with tax return. You just say, hey, I used 3,284 gallons of fuel, and whatever the tax rate is per gallon, then you, the federal government, owe me so many dollars on the back end. this has been going on for decades, where people just put in numbers there. And
And for this year.
at this point in time, so people used to get refunds out of this, but at this point in time, that is pretty much a guaranteed audit. And it's just don't do it. It's, let's say 99% of the time, the people that claim this are not legitimately claiming their credit, and then they will get audited as a result. There are, and I could go on, but there are things that don't make any sense, because on a tax return, what you're doing is you're telling the government, hey, here's what happened this year in numbers. And I'm explaining to you, the federal government, the character of the different numbers that I had. And based on that situation, my tax liability is this. And then it's up to the government to do an audit. And an audit is just asking questions. So say, okay, let's prove that. That's all an audit is. Now, how easy that is to prove or not depends on a lot of who you get as far as an audit goes. And the vast majority of the time, what the IRS get people on, quote unquote, is documentation. They say, okay, you claimed 3,824 gallons worth of fuel for federal fuel tax credit. Show us your proof that you did that. And most people can't come up with the proof. And that's the problem. In IRS speak, an audit is a tax examination. So they're examining the return in detail, and they want to see the corresponding documentation that proves or supports the numbers that were reported on the tax return. So as long as you can do that, then you'll win an audit. How painful it will be depends in large part on who you get as an auditor. I'm of the opinion that you should take every last deduction you are entitled to and minimize your situation as much as possible. At the same time, I understand the people who are more skittish about it. Is if this is going to increase my risk of audit, I don't want to do it, even if I'm entitled to it, because I just don't want to go through the hassle. I get it. It's a decision that everybody has to make as far as what is their personal level of comfort with things. But yeah, so when you're explaining that story to the government, you have to ask yourself, does this story make sense? If no, it's a problem. That's what it comes down to. If yes, then it probably goes right through. So that's the basics behind audit. Obviously, you could dive down into that as deep as you wanted to go. In the old days, Ken Clyde, who had moved from New York, and he ran a little clothing store in New York, and he was like as aggressive as he could possibly be. And he had a whole strategy for dealing with audits. And he would call somebody, and then he would get this letter from the IRS, and it said, call the office, who could set up an appointment. And he would make the appointment for like 4:30 on a Friday. And because he knew when he went into the office that the guy across the table from him didn't want to be there. Weekend's coming up. He wants to go out the door, right? So let's wrap this up as quick as possible. Flip through papers as quickly as you can and get out of there. And then he would always strategically leave some documentation at home. So, I forgot that. We'll have to reschedule and try to play the game again and try to get somebody else. He's an auditor. These things don't work well because they don't really do in-office audits anymore. It's more correspondence audits. So basically just letters back and forth. But it was a funny trend back in the day. When that applied, I'll tell you one quick other audit story. So my dad, this is before I ended taxes at all. And because he was doing weird stuff, I ended up looking at what he was doing. I was like, yeah, that's a little odd. But so he audited 1 year, and he's retired and he's got nothing better to do. So he goes out of the office, right? And he's got a binder. I remember in our house in the laundry room, there was like this little built-in kind of desk area. And on the top shelf, there were these binders. And the binders were all of his old tax returns going back to 1970 something. So for the audit, he goes in and he brings all those binders of tax returns and he sets them on the table. It's a stack like 6 feet high or something. And he says, you've accepted this thing that I've done for whatever, 30 years, 40 years, whatever it was at that point. Why is this one a problem? And the operator just looked at him and says, okay, just go. It's too much work to argue with this crazy guy who has too much time on his hands. Yeah, it's all about who you get as far as one with the auditors and what you can bring to bear. Fundamentally, they're just asking for documentation. Okay, do that. Have the documentation, do all the things, have the paperwork, have the paper trail, and be able to demonstrate this number comes from this place over here because of X, Y, and Z. And if you can do that, then that's it. and you'll be able to win an audit. But again, not going to be pleasant, just because the process is the punishment in those kind of cases. All right. So that brings us to the end of the hour. We will do this all again next week. And if you have ideas for what we should name the show, as far as defunding the government, let me know. Email office@taxsherpa.com and put in your suggestions. Or if you're on the Navigators or Explorers group, you can put them on the board, and love to hear from you. All right. But that's it for this week. Do it again next week, 6 p.m. Eastern, Tuesday, whatever, November. That's going to be November 5th. Oh, it's going to be cheating. Maybe we'll do some live streaming election coverage and see what that means for taxes.
Yeah, let's do it.
All right. Catch you guys next week.
Alrighty. Have a good day.